Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to go through the EIA numbers and do what we kind of normally do, going over, what is the overview, what did the refined products do, and then how do exports look, and then what does this really mean going forward. So just jumping right in, we can see that the crude, we had a nice draw across the board of about 7.38 million. Now, this sounds great, and everything is starting to move along in the right direction, specifically at the PADD 3 level. We have production that's come down a little bit, but again, we were already at about 10.9. So we think that by the end of this month, we'll get to about 11.2 to 11.3, just as we have some new completion work coming to light, as we've been discussing in our Frac Spread show. So this is something that we really want to look at, specifically PADD 3, because PADD 3 continues to see these draws, and we had a hiccup. We had the storms coming through the Gulf of Mexico. Now we have the storm that just came up through the East Coast. So some of the numbers will be a little wonky, but we can kind of push through that and really kind of look at, all right, well, what does this mean for the next few weeks? And that's why we always go to, where are we on total inventory levels? So here you can see we're now back below that high of 2016, but this is typically when we see some of our biggest draws as we go through the rest of August. The problem is going to be, how are those really on the go forward level? And when we look at the physical market, as spot crude moves around, we continue to see headwinds across the physical world, really being driven by discounts across Nigeria, Angola, Urals, and we're still waiting for the Saudi OSPs, or official selling price, which will come out Thursday. So these are things that are going to continue to kind of weigh on, well, what is going to happen for the U.S. specifically in terms of exports. So, and at the same time, if we continue to see some of these discounts start to appear in the market, what is that going to mean for U.S. imports? Are we going to take advantage of those imports the same way we did in the previous downturn? And that's why this is where we continue to look at PADD 3, because PADD 3, it's had a nice draw over the last couple of weeks, and it's something that's going to continue. But you can see how far we are from those previous highs. So there's still a lot of wood to chop. There's a lot of things to continue to work through. But the problem is there's going to be additional pressure on our exports. So as our exports continue to come under pressure, you're going to start to see some of these draws start to slow down in pace as some of this crude is left on shore. And that's where we really kind of go, what does the overall market look like? And the imports is interesting, because it really wasn't driven at all by PADD 3, but really PADD 2, which is the Midwest, and also PADD 5, which is the West Coast. And these are the two areas where we saw the biggest increase, which there's always a piece of timing, a piece of, what are the timing delays. So the West Coast is going to see a dip, this week and into next, just as you start to see some things normalize. But PADD 2, we think, is going to continue to see a relatively strong import level. Now, it won't be at the same pace, but it's still going to be something that we're seeing just because companies are taking advantage of some of this flow out of Canada and into their market to try to really make the best in terms of a terrible world, as we see crack spreads just get decimated. And that's when we start to look to runs. And when we look at crude utilization rates, we had a small tick up of about 10 basis points, but again, it's small, and there's pressure building on both sides. And that's where we think we're going to start to see additional run cuts, specifically with crack spreads doing what they're doing right now. The biggest issue is you're getting a big price move in crude. If you want to say it was because the dollar got decimated in the overnight, so now commodities are running, there still remains a demand problem as these crude runs continue to slow, not just in the US, but also globally, specifically in India, where we're starting to see some of that pullback, as well as China. And that comes down to implied demand, because the implied demand is a calculated number. It's a number that we have to just consider. It's like, okay, it's kind of an estimate of where we think things are. but we can see that the implied demands came under pressure, specifically in gasoline and distillate. Now, the gasoline is a timing delay, which we'll go through in a minute, but you can see that there was a slowdown in implied demand kind of across the board, which is something that we'll see reverse a bit this week into next week. And that's why we look at the U.S. Gulf Coast, floating storage. We had that shift higher as we saw, ships get pushed back into the Gulf ahead of the storm, which has now started to normalize and started to come to dock. So this is, again, some of those timing delays that we're talking about. So we'll start to see an increase in imports over this week and into next week, as a lot of these ships that have moved from floating storage to port will start to register in the numbers themselves. And that's why when we look at the crude oil imports, we expected to see that decline. We expected to see it come down, but it still remained relatively low. And it comes back to what were the runs happening and what was happening with the refiners in that area, because it's always a timing delay of, getting the right feedstock to make the right product. And that's why this is something where we think we're going to get a shift higher over the next week and the next 2 weeks or so, as we start to see some of that crude that's coming off the water get registered into the tanks themselves. And that's why when we look at what is happening in refinery utilization rates, we maintain that, we're going to average that 75% through the summer months, but we're going to start to see some of these rollbacks as we go through the remainder of August, which is going to put additional pressure on total crude demand. Marathon has come out and said that they were going to, permanently idle or furlough, 2 refiners that were shut down due to demand. And as crack spreads continue to do what they're doing, you're going to start to see more refiners start to normalize or rationalize, based on how we continue to have builds across products in the U.S. And now you have crack spreads coming lower. Do we really need to maintain some of the operations that we're currently keeping at the current rate? Now we can turn to products, and one of the ones that we always like to start with is distillate, just because how it really interacts with the global economy and specifically the U.S. economy on these levels. And you can see we had a very large build of 1.59 million barrels. Now, this is going to continue to be a problem because we continue to get and push towards tank tops, or what people like to talk about, tank tops. The benefit with clean products, which is really what is deemed, jet fuel, kerosene, distillate, gasoline, there's flexibility as to where can you store this. You can store it underground, you can store it in different types of boats. So even though we can say that we're getting towards tank tops, there is optionality. So we don't have the same kind of stress. But at the same time, it's also a great indicator of, well, how bad is the build as we go into the shoulder season, which picks up in September. And you can see we continue to set new records on all-time highs. Now we keep pushing back to the 80s as to where we sit. This is going to continue to be a problem, because this is where refiners are sitting there and saying, okay, well, I want to make gasoline, but in order to make gasoline, what am I going to do with my distillate cut? How do I get it out of the system to kind of keep things and keep the tank storage available in order to keep operations flowing, which is why we continue to think that there's going to be a weight on just refinery runs, especially as we see crack spreads continue to flounder. And that's where we go back to, well, what is happening in the market for the demand levels? And we've been saying from the beginning, that we were going to kind of suck around this 5-year average, which continues to be the case. Now, we saw, some exports, remain relatively a little bit stronger than I think what we expected. But at the same time, those are going to be, keeping things keeping the options open, keeping things flowing, and that's going to be a problem as we go forward, as pricing remains under pressure, just because there continues to be pricing issues with the lack of demand. And when we turn to lack of demand, we always like to look at what is rail doing, and you could see rail had another big down move, versus 2019, and this is going to continue to be problematic as when we look at shipping and we look at rail, there continues to be that slowdown. Shipping is starting to creep up a little bit, which is good to see on an economic level, but also just in terms of a diesel demand level. But shipping is one thing, but rail continues to be a problem as we see less and less moving through the U.S., which, again, as we start to go into, how are the consumer spending? How's industrial output? We continue to see employment weaken. We continue to see unemployment increase. And these are going to be issues as we consider, well, how is stuff moving around the country? And that's where we always like to look at trucking, because trucking continues to really outperform, especially as we look at it versus shipping and rail. And you can see we're starting to kind of normalize at this outbound tender level as FreightWaves looks at things. And you could see we had that strong move specifically against where we were in 2019. But, when we consider as we've come out of kind of that COVID lull with those lockdowns. Now, there's a lot that's going to be talked about. In the economy show, we're going to go through PMI and what does that mean for, when we consider inventories, when we consider where are people's inventories, where's consumer demand, and then where is the product overall. And that's why we're going to continue to look at trucking, because it should continue to outpace kind of where we were a year ago. But the question is, how is that going to look for diesel? And it's going to help absorb some, but again, refiners continue to overproduce just because we don't see the demand on some of these big bellwethers from shipping and rail, and exports remain light. And that's where we go into gasoline. So gasoline had a small build of about 420,000 barrels, and you can see we continue to outpace, the seasonal norms as we look versus, going back to 1991. We're still following this general trend, but the problem is we're starting to see the build start to creep higher again. Now, we had a big drawdown as we prepared on the East Coast with, movements of gasoline. So this is looking at gasoline before it goes to the rack. And then once it goes from the rack, which is just the actual rack that loads it onto a truck that takes it to the end user, we're getting some disconnect between the two, which is good to see because it means that we're going to get some additional pull through, which means we're going to see a nice bounce in demand over the next week or two. And that's where we look at, where we sit right now. So there was some prep as the East Coast prepared for the storm coming through. There was some backfill based on the storm that came through Pad 3. And this is where we saw that decline to about 8.6 million barrels a day of demand. Now, we're going to get a bounce here. We're going to get back to about 8.7 to 8.8 as we go through the remainder of this week and into next week. But there's going to be a little bit of wait in terms of, well, when does that really start to appear? And for anyone who's in the Northeast, you're experiencing the same power outages that I have. Some people typically will go and fill up ahead of time. And we saw that in Florida. We saw that across the East Coast. And that's why when we look at the Gas Buddy data, so Gas Buddy data was showing that there's going to continue to be that demand increase. And when we look at it, Gas Buddy is saying that Tuesday, so looking Tuesday over Tuesday, there was an increase of 1.48%, so about 1.5% increase week over week. Now, that was good to see because it means that we had a bounce last week as people prepared, specifically in Florida and other areas of the East Coast, and we saw some follow through. Now, this is something that's going to kind of play its way through. So as the retail side pulls down their inventory, they have to pull from where the EIA would pick it up. So that's where we're going to see some of these numbers, not jive for a week or two as things kind of normalize through the system. But again, crack spreads continue to weigh on numbers. And that's why we think that, we continue to say that kind of 8.5 million is going to be the average through the year, but it's good to see that we're seeing some of that pull through. And that's when we, now turn to jet fuel. So jet fuel had a continued move lower, and it really comes down to just we knew there was going to be an addition of departures, specifically in the U.S. coming into August, but those numbers continued to get reduced in terms of where we thought we were going to be based on expectations in June. And you're starting to see that show up in jet fuel total demand. And the reason why we think this is going to kind of hold this level, this is what we talked about a couple weeks ago, where we're going to have highs kind of hold at this peak, but we're not going to get down to where we were during let's just call it peak lockdowns. And it's just because we're starting to see those TSA passengers kind of hold in this comfort line of, let's call it 550,000 to about 850,000, depending on what time of the week. And you can see that we're still well off by about 2 million people on a year-over-year basis, and we're just not going to close that gap. You're just not going to see that kind of movement. But we are going to kind of normalize at this level, and it's going to be a little bit. There's going to be a difference between the different locations, and this is where we look at the global summary. So China has added back some of those departures that we saw that were taken away as they fought their own COVID increases, but we're starting to see some other areas of the Asia Pacific start to come down as there's increases in COVID cases in specific pockets. Germany is one that has had their own little pocket within the capital, and that's going to be an issue in terms of, well, how much do we roll back, how much do we see? But you can kind of see the steady increase as we go through August, with the U.S. seeing an additional increase. Now, the U.S. saw an increase of about 81. We should see that ramp up through the next week or two. But again, we're not going to see the same type of total jet fuel demand, because a lot of that has been pre-ordered. A lot of that has already shown up at the locations. So it's going to be difficult to see some of those normalizations. And that's when we get to that Google mobility data, and we start to see how, again, this is kind of the trend where everything is remaining relatively stable, but stable at a depressed level, which is where we kind of get that comfort as we consider where we should be on a seasonally adjusted level as we go through the end of peak driving season. Now, these are key issues, and you might think it's like, all right, well, when we look at the mobility data and we look at what people are doing, retail has kind of leveled off, and that's something that we think is going to turn to the downside, especially as we go into the fall and winter seasons, as we spoke last week, considering, when you get a cold, do you quarantine? Do you get tested? We are going into our normal cold and flu season. So how are people going to react? And the easy answer, or the easy family answer, is just do less. And that's something that we think is going to become a bit more standard as we go into those pivotal months. And then when we look at OpenTable, again, the trend continues to be a slight uptick, but it's still going to be difficult to really get back to that normalization as we get issues in terms of, where are people willing to eat indoors? Are they willing to eat outdoors? Would they rather just remain with takeout? And on a global level, we are holding that 55 to 60% decline. But we are seeing those bright spots. The bright spots are now coming into the UK. We're starting to see a positive increase. Germany remains to hold those positive moves, but really we continue to see problems within North America, specifically with the US and Canada. And Australia has started to roll backwards as we've seen COVID increases within Australia, and we're seeing something similar in Japan, where we actually had a new restriction on COVID movements, which is going to be problematic as we look to, okay, well, this is what's happening in the world. This is what's happening in the U.S. Now, what does this mean for U.S. exports across oil and refined products? Now we can turn to exports, and we're going to first kick off with products. So first, we see that gasoline had a nice increase of about 329,000 barrels. The problem is going to be going forward. Latin America has come under additional pressure in terms of COVID and then just economic weight, which is really starting to slow down their imports of gasoline and distillate across Latin America. This is something that's going to be a huge weight as we consider gasoline movements over the next few weeks. The other problem is we've had a big increase in gasoline imports from Europe into PADD 1. So as the gasoline arb reopens, we're seeing more European gasoline show up on PADD 1. But as PADD 1 starts to, as we've seen a slowdown in demand or stabilizing demand and an increase in builds, some of this gasoline is going to have to get redirected. So there's going to be additional pressure in terms of, well, there's a smaller piece of the pie to try to compete for within LATAM, which is showing up in distillate as well. So distillate outperformed a little bit where we thought exports were going to be. We thought they were going to be down, but they weren't down as much as we initially perceived. And here there was a decline of about 111,000 barrels. But again, it wasn't what we think there's going to be another step down over the next few weeks as we see this economic pressure really ramp up within LATAM. Now, exports is another one in terms of just crude. And we thought that there was going to be a decline as we see imports start to increase, exports start to decline. And we didn't really see the imports show up, but we did see the exports slow down, which means that we believe that imports will see an increase into PADD 3 and exports will remain under pressure, specifically as spot cargoes and what we think OSPs will be through the remainder of August and September from international barrels will put additional pressure on new crude exports. And that's where we turn to just looking at this on a seasonal level. So you can see that on a gasoline export component, we're getting back to the seasonal highs. Now, we continue to believe that we're going to kind of hug that 5-year average, which is why we believe that, over the next this week, next week, and really through the remainder of August, we're going to see these exports decline and then kind of hug that 5-year average, especially as we see additional weight within Asia, where we're actually getting more product being exported from Asia into some of our markets, specifically into Europe and into LATAM. And that's where we turn to distillate. So we thought there was going to be a decline of distillate exports back to the 5-year average. And you can see that we got right to that level. Now, we believe that there's going to be this shift in terms of, slightly above, slightly below, and we're going to kind of hug this line. The question is going to be is how big are the imports coming from India, coming from South Korea? Because we're starting to see some shifts. So Japan had a big increase in crude builds. They had a big increase in distillate builds, and Fujairah had a small decline. But you're starting to see these shifts in the market as China remains a huge problem in just the amount of oil sitting on their coast, the decline in runs, and now the increase in exports, specifically in distillate and gasoline. And as India faces their renewed lockdowns in specific locations, you're starting to see them export even more. So this is why the U.S. distillate exports, we believe, is going to fall under additional pressure because those cargoes are going to compete specifically in Europe and will start to show up in Latin America. So these are key reasons why we think that there's just going to be an inherent problem in terms of how do refineries function. And if refineries can't function, then that's direct oil demand. And these are things that are going to continue to weigh, even though you wouldn't be able to tell based on how crude is doing right now. But these are things that we're seeing in the physical market that we think hopefully at some point they start to appear within the paper market. So we're going to do a special update on Lebanon, and then we're also going to have our economy show coming up, and then our favorite topic, the primary vision frac spread count, where we'll also do a quick OPEC update within that show, just to give you an idea of what we spoke about here and how that's going to impact U.S. flow and U.S. production. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.